Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO Founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul speaks to Ken Esch, partner at professional services firm PwC, about the extraordinary optimism at private companies in the U.S.
You know, there's almost no such thing as a flawless report like this, but I really struggled to find any dark lining to the silver clouds in this. What do you think?
Yeah. No, I agree. I mean, I think that you look at this report and there's something positive in here for everybody.
Yeah.
And I think that, from an employer, perspective, things look good from a growth perspective. Margins, are doing well. Few barriers to growth. Everything seems to be down except for maybe some lack of qualified workers, been a persistent issue. And then from an employee perspective, more companies are out there planning to hire. They're expecting to add more people to their workforce than they were expecting last year. So things are percolating along, I would say, in the job market as well. So there's a little bit of something for everyone here.
Yeah, it's really an extraordinary report. The touching on what you had mentioned, the skill level issue, you're right. That's been obviously a sort of a ubiquitous issue for quite some time now, and kind of gotten worse as time goes on. I mean, did that really sort of come out in your survey again, or does that seem to be tempered a little bit?
No, it's still registering as an important barrier to growth. It's the one that actually increased from last year in the past survey versus many of the others, which have come down versus prior year. We consistently talk about lack of demand for products and services, but that's falling again. And really, the only one that is increasing concern is this lack of qualified workers, and that's probably going to get worse before it gets better.
That seems to be the word on the street. It really does seem to be an increasing challenge. The other side of it, again, I'm looking for potential problems in your report, and they're few and far between. But on the hiring front, yeah, it was great to see that there's a lot of folks that are planning to hire. But the wage pressure doesn't seem to be really coming through. Am I reading that right? Or wages still seem to be a little bit depressed?
No, you are reading that correctly. We have not really seen the upward wage pressure that you might expect to see coming out of a recession. Particularly where we're seeing employers tell us that lack of qualified workers is a problem. But the inflation has been so low, for a long period of time here that you don't really have that inflationary, pressure, in wages that we've seen in coming out of other recessions. And I think employers are looking for other means, to address, their workforce and keep them happy and employed, as opposed to just paying them more. So, for example, we're seeing, companies offer terms and flexibility, for example, into where and when you do your work. They are providing some other, benefits like wellness programs to employees to keep them engaged, rather than just paying them more money, to try to keep them happy through wages. But that's not going to last forever, right? At some point, the concern about attracting and retaining qualified workers will impact that labor rate. Low inflation isn't going to be here forever. That will start to affect wages. So I think we enjoy it while we can, at least from an employer perspective. And from an employee perspective, I guess we can be thankful that we're not seeing inflation higher than our wage increases, and therefore, eroding our real compensation. Right.
Now, the energy, obviously the margins are just spectacular, as reported anyway. and a chunk of that obviously is low energy costs. Did you get anything through your survey, either anecdotally or through the actual data, that suggested that the lower energy costs have actually had a negative effect? Because oddly enough, in reading a lot of the macro information, the low energy stuff has been detrimental in some ways to the overall economy. I don't know if that's true within the private sector or not, or the private company sector or not. I mean, did you get anything, any sort of inkling of that?
We do have clients that are in like the oil services industry, for example, and the low energy prices and oil prices, are affecting those businesses. Many of them have pulled back on their CapEx budgets. Many have, reduced, their workforce. So there are pockets of the economy, that being one of them, that are feeling some pain from low oil prices. But others are seeing some benefit, in their margins. Transportation, for example, is feeling some benefit from lower gas prices, and that is one of the inputs, for our survey participants more broadly. So when we think about margins, we really think about two factors, that result in improved margins. So maybe the first being, a low cost structure. Energy is a component of that, but we also really haven't seen much in the way of inflation, and we haven't really seen much in the way of increased, wages, both of which would be, significant components, in your cost structure. Really haven't seen much there. And then on the other side, which is your ability to push price increases, we're seeing, our survey participants tell us that they have been able to command some higher prices, in the market. So you're increasing, the top line by pushing price. You're maintaining the bottom line, with the stable cost structure, and that's translating into, better margins. So I think we enjoy those while we can. May not last forever, but hey, enjoy it now.
Take the money and run, baby. Yeah. I guess the other interesting thing I saw in the report was regarding the international perspective. And two things really sort of jump out at me there. There seems to be a little bit more negativism about international markets overall, which is understandable considering the state of the global economy right now, or at least the uncertainty therein. But then sort of the enthusiasm about emerging markets. And I'm wondering, with all of that, also the strength of the dollar, I would think would be challenging for folks, at least people who sell overseas, not necessarily who manufacture overseas, right?
Yep.
What am I reading that right?
Yeah, I think that that there is concern out there about the international markets, including the emerging markets, and in the survey, it jumps out at me in a couple of areas. First, maybe being the outlook and optimism levels, are certainly lower, for the international economy than they are, for the U.S. economy. But if you look at the uncertainty and pessimistic, views out there, both are very low. For the U.S., only 2% are telling us they're pessimistic, which has got to be as low a reading as I've ever seen. And then on the international side, only 9% are telling us, that they're pessimistic. But there's a much higher, percentage, of the population on the international side that tell us that they're uncertain. And, that's not a surprise, to anybody, just based on what's going on in Europe, with the low growth / recession, pressure, and then maybe lower growth rates than what we've experienced in the emerging markets. So that's certainly a concern, but there is some positive news in there, and that it's pretty clear that through the low pessimism levels, that our survey participants tell us that the worst is behind them. and that they can kind of plan for the future. I think with a private company, you don't have to worry, about managing to a quarter, like a public company, might.
Right.
So the Trendsetter participants are not abandoning, growth, within these foreign markets. It may be slowing, a little bit, but they're not going to abandon it because they know from a long-term perspective, their opportunities are going to lie in these foreign markets. So we do see that the hiring is skewed a little bit more favorably, to companies that are operating internationally. So that, they're expecting to hire even more than domestic-only companies. And we do see that international companies are expecting to maybe invest a little bit more than what we might see in a domestic-only. So, yeah, it's not a great picture, out there on the international side. I would say that our participants are saying that the worst is probably behind them. They're proceeding with caution on their investment, plans, and certainly not abandoning any activity in the foreign jurisdictions.
Right. I guess another thing that struck me was, given this fantastic environment and everyone's optimism about growth, and just the general sort of tailwinds that seem to be blowing for private companies, it was interesting to me that there seems to be sort of I guess you can call it prudent, or I guess you can call it moderate or restrained or whatever, but there seems to be this we're not going to overinvest kind of feel coming from the report, right? I mean, everybody's maintaining their sobriety, as it were. Man, what is wrong with these people? But it would appear from CapEx and various plans in terms of expansion of facilities and all that stuff. No one's getting giddy over this. They're liking, as you said, they're liking the current situation. They're taking advantage of it, but they're not going to sort of roll the dice. It seems.
Yeah, I think while the recession is getting further and further behind us here, we haven't forgotten about it. And the Great Depression changed behaviors for a generation.
Yeah.
And, I think it's yet to be seen whether behaviors really will change on a long-term basis coming out of this recession. But I think it's still close enough that people remember the pain of a collapse in the economy, and that they don't want to be back in that position again.
Right.
So I would say that their investment is measured, and they're definitely looking for a quick return on that investment, whether that's people in the sales and marketing function, for example, or on the manufacturing floor. They're looking for new hires to contribute quickly. And they're proceeding with caution with respect to, CapEx, and would like to see that order base solid, before they commit, to large capital expenditures. We are seeing, increased operational expenditures, particularly on the technology side, where they're, streamlining processes and keeping up, with the new technologies. But we're not seeing the large increases, in the CapEx, nor are we seeing, companies, borrow aggressive, against the lines of credit, that are available. That's ticking upwards, a little bit, but, with very low interest rates and in a covenant-light, environment, you might expect companies would be a little bit more aggressive, making investments and borrowing against those lines, but that just really hasn't materialized.
I guess sort of the conclusion. I mean, it's a pretty damn positive report.
Yeah, it is. Yeah, I think probably as good a report as we've seen, since we've talked, Paul, and a little something here for everybody, to make them happy, both on the employer side with solid, continued, growth over the next year, margins improving, on the employee side, it looks like that they're going to have more opportunities. They probably should be expecting that the labor force is going to continue to be absorbed as new opportunities come online here. So I think a little bit something positive for everyone.
Be sure to check back for future episodes of the President and CEO Focus on the Middle Market podcast series. Thanks for listening.